Hey everyone, welcome back to the channel. So in the last video, I presented a take into why we think that equities are in a Goldilocks zone, but today I want to talk about some of the recent developments that we think potentially could start presenting headwinds to equities in these next few months here, and that we're going to continue to monitor and then present to you all going forward in the next few weeks. So to start, I want to present the 10-year minus the 3-month Treasury bond yield curve. Then we're going to go into the ADP employment report, and then we're going to talk about some internal market technicals and do a little bit more of a technical advanced analysis. Let's go ahead and get started. In this past week, really since the 28th or the 26th of November, what we can see is there's been this precipitous steepening of the 10-year minus a 3-month yield curve, and this has actually gone past 0.40, and it's like around 0.44 today. Last time I checked on CNBC, it's just the Fed website, and what we see is that typically when we see this steepening, right, which is just this rate increasing in this 0 to 1 range, that typically tends to coincide with recessions. So if we can look at the recession here, 2001, that coincided with 10-year minus a 3-month Treasury bond yield curve increasing in that 0 to 1 range. Same thing with 82, same thing with 90, and then same thing with the Great Recession. It's not just voodoo magic and like, oh, it's the yield curve. What does that even mean? The yield curve, you're just taking the yield you get on a 10-year Treasury bond, and then you take the difference between that and a 3-month Treasury bill. Why does it actually matter? Well, it actually matters because typically that steepening means that the Federal Reserve is cutting interest rates. They're reducing that Fed funds rate. And the 3-month is just moving in advance of that. That's people saying, hey, I think the Federal Reserve is about to cut rates, so I'm going to go out and I'm going to buy 3-month Treasury bills because they're probably going to yield less a month from now. When people expect the Federal Reserve to cut rates, why are they expecting the Federal Reserve to cut rates? Well, that's because of economic weakness, right? So it's all about why the interest rates move the way that they do. Front end of the curve, the short end, those yields that you get on an interest-bearing like savings account are far more impacted by the Federal Reserve cutting rates to spur economic growth, to incentivize you to go out and invest in the real economy, not just save that money because you're not getting as much return on your deposits at a bank, right? You're incentivized to go and spend that in the real economy. And why does that matter? Well, what is like basically pushing those front end rates lower? That's the ADP employment report. And what we can think about here is the more cyclically exposed, right? Basically, if there's any economic weakness, the businesses that have the most exposure to that tend to be smaller businesses. They tend to have anywhere from 1 to 50 employees, and also probably have more exposure to tariffs. They're probably running thinner margins, and they may be importing goods from China, and then when they see tariffs come in and compress their margins, if a person retires on their team, they're probably not going to go out and hire a 24-year-old college graduate. They're probably going to say, hey, we're cutting back on costs, let's just let that go and try to make do with the people we have, right? Because we're not seeing the same level of profit margin that we were a year ago, 2 years ago, God forbid in 2021. And so those smaller businesses that have those thinner margins, fewer people, are cutting back on labor, whereas the larger businesses that probably have more cushion are increasing their hiring, or at least they're still hiring and they're adding jobs. But what we've seen in the last 6 months nationally is a flattening. We've actually seen it go down a little bit, right? This ADP employment number, and the thing is that it tends to coincide pretty accurately with the actual employment reports you get. And so the ADP report post revisions tends to be accurate. There's just not as much history of the ADP report, but it is accurate post revisions for the Bureau of Labor Statistics. They tend to correlate pretty accurately. So it is a good reading on the labor market. And there are other ones that say similar things. I think it's like Revelio and Challenger are the two that I looked at during the government shutdown, and they were both indicating the labor market weakness, at least on the hiring end, looks to be accelerating. So let's go ahead and we'll go into how is the market reacting. If we look at the performance of the cyclical ETF relative to the defensive ETF, what we can see is that in 2021, during that earnings recession, not in BER, but there was an earnings recession at that time, what we can see is that there was this weakness, this deterioration, and XLY underperformed XLP. So cyclical stocks underperformed defensive stocks. And then if we look at the performance since the recovery in 2023, what we can see is that cyclicals have actually outperformed defensive. And there was this tariff blip here, right? But we've actually gone back up to the level we were at before, and we've actually surpassed it a little bit here. What you tend to see is that when this value goes down and it continues to go down, it's typically not a good leading indicator. And let's actually look at the Great Recession as an example. So the labor market didn't really actually start to deteriorate until November or December of 2007. But if we look at the XLY to XLP ratio starting in July, you saw this massive decrease, basically bottomed down, and it never really recovered and went significantly above the moving average until January. So the market basically internally was telling you, hey, there's a lot of risk going on in the market right now, right? And it continued to go down until the Great Recession was basically over in 2009 and recovered. And then once it recovered, it continued to move higher up until like 2017. What we're seeing here is potentially a flattening or maybe moving over. Time will tell, and we'll let you know how this is going over time. But the main thing I want to talk about in this video is the performance of tech stocks in the XLK ETF to defensive stocks in the XLP ETF. And this is what's primarily concerning for me. When we look at this ratio and we look at these 3 standard deviation Bollinger Bands, really you don't need to know what they are. It's just to give you a range on like what you can expect. What we can see is that from really around 2002 to 2016, we really just were in this one range. We were in this 1 to 0.7 range of the value of XLK, which is the technology ETF, to the defensive ETF, right? So it's like you got roughly the same performance between tech and defensive stocks over the course of a pretty, I mean, you had this, obviously the dip in 2007, the Great Recession, but in normal times you hover around a 1.2 to it's like 1 range, somewhere in this area tends to be normal. And then the 2 anomalies we can see on this chart are .com, where we saw this massive run up from 98 to 2000, and then the drawdown was just vicious. And then what we've seen since, what I want to isolate here is this same Altman tweet on November 30th of 2022, saying today we launched ChatGPT. If we isolate that day on a chart, literally right here, and then the second that data on ChatGPT usage started to come out, I don't know if all of y'all remember that, but it was insane. Like the number of new users, whoosh, up and to the right, just going from a level like 1.6, which is pretty normal, to 3.7, which is extended at or beyond the levels that we saw in .com. So there's been a lot of outperformance of tech relative to defensive that's really only been preceded by .com, the .com bubble. And so does this 100% mean that these stock markets are going to crash within the next year? No, it's all probabilities. You could see defensive stocks drastically outperform. You could see a world in which, say, defensive stocks and AI lives up to the hype. There's AGI, and then these defensive stocks are able to massively increase profits, and there's an economic golden age, and then the performance of the defensive stocks keeps up. And if you're an AI absolute optimist, maybe you could say that's how this is going to equilibrate here, right? You're just going to see so much growth from the people who use AI that this value is going to return to normal. Totally possible. Or what you could see is a replica of 2000. It goes down because the numerator, your technology ETF, goes down. I don't want to give numbers, but it would be vicious, and you see slight outperformance, and maybe defensive stocks go up somewhat, but you would largely see this go back to the 1 to 1.3 range via the XLK ETF falling precipitously. And so that's what I'd like to really give here, and that's the insight, which is that post 2021, if it wasn't for ChatGPT, I mean, you can never really know. But my 2 cents is that if you were to isolate this, we probably would have returned to 1.5 and then gone back to normal. We likely would have returned to a normal stock market range. And you can almost isolate it in the chart to the day that ChatGPT released and you saw this AI bubble. That's just something worth noting. I think a lot of people out there are telling you that there's not an AI bubble, or they're debating it. I think it's pretty inarguable that there is one, and whether or not it's justified, I think it's an entirely different conversation. Yeah, it's leading to risk in the markets, and if you're comfortable taking this risk, then go ahead and go for it. Our forecasts see the stock market moving up in the next month. That is true, but there is still, like we talked about in the last video, a ton of what's called a left tail risk. Basically, .com. The further up you go in these metrics, the more room there is to fall. That left tail, you go up, and there's a slight probability of the market moving down a lot. And what happens is that as you keep moving higher, that left tail risk only grows. And so that's just something I'd like to note, and that's what we're going to cover here at Whitfin. Hope to keep everyone informed and making informed investment decisions via understanding the probabilities in markets and using machine learning, right, to actually help improve investments, and using all these indicators to give you a quantitative structure behind your investing so that you're not falling blind into this. Because I think that a lot of people are. A lot of people are like going into the hype and they believe it. And maybe it's true, but there's a lot of risk. Be careful out there and talk with a financial professional, financial advisor about what's best for you. Go to Whitfin and subscribe, and if you're choosing to invest your own money, then understand the risks in the market and understand what exactly Whitfin's giving you, right, which is probabilities, helping you understand where things are going, but also come into it with a holistic view that there is this probability of decline. And you can come to us and watch these videos in the future to understand where things are now and where they're heading. Maybe it continues to move higher, and we will keep tracking that for you and keep releasing these videos. But if it does go down, we'll also be telling you about that, and we'll also be making those types of notices on our site. Go to whitfin.com today, sign up, and we hope to see you there. Thank you.